thank everyone for coming tonight. My name's Gabriel. I've been with Aberdeen for 16 years with their emerging markets team, about 7, 8 involved in co-managing Aberdeen Asia Focus. Asia Focus is really, it's a trust that's been around for 30 years, and I think the objective, really, to put it simply, was to give UK investors access to very difficult to access companies in Asia, so smaller businesses in a very large part of the world, and that objective really remains true to this day. You'll notice that we still have Aberdeen there without the vowels. That's because as an investment trust, the board haven't yet changed the name of the trust, but that might be forthcoming in due course. In terms of the opportunity to invest in smaller companies in Asia, we'll come into some of the details around performance, but essentially, Asia is one of the biggest parts of the world from a demographic point of view, from a growth point of view, and therefore we think that this is a place that's underallocated in many portfolios. I think George was talking about how concentrated equity markets today are to US markets, and Asian smaller companies does give you a lot of diversification and a huge amount of uncorrelated companies that we can come to talk about. We have a team of about 35 people on the ground in Asia who've been investing in the region for about 30 years. We have a very differentiated portfolio, even versus the small cap benchmark. So active share is a measure of how different you are to your benchmark. That active share is 96%. And that's partly because the small cap universe is very fragmented. It's not like the large cap index where you have these massive mega caps. It's very fragmented, essentially. In terms of other details about the trust, we have a dividend yield. Despite this being a growth asset class, the trust yields about 2.5%. The board have committed to a progressive dividend, so that's the minimum amount that we'll be paying going forward. That's paid on a quarterly basis, and they've been also doing quite a lot of buybacks over the last 6 months or so. We do have a conditional tender offer in place, similar to the previous trust, although ours is dependent on whether we outperform our benchmark or not. Over 5 years, 25% of the capital is returned to shareholders if we don't outperform. I should also mention that we are geared. We have about 10% gearing on the trust, which over a long period of time has added about 1% to our net asset value. So it has been additive to performance over time. As I said, the trust has been around for 30 years, and this just shows that absolute performance has been pretty decent over that period of time. The AIC has just released the sort of ISA millionaires list. Asia Focus is number 6 on that list, just behind trusts that invest primarily in private equity, in technology, and in US equity. So we think that that's a pretty good result. The NAV return per annum over 30 years has been about 13%, which we think is sustainable over time, because when we look at our portfolio of companies, we do think that they can deliver at least 12 to 13% earnings growth in dollar terms going forward. So if you believe that earnings should track, or share prices should track earnings growth, we do expect that to be sustainable, with obviously some pretty big volatilities over the years, given we can't predict what markets will do in the short term. I don't want to sound too promotional, but I think one of the key debates in markets these days is whether to invest via ETFs or to invest actively. And this slide just shows how, compared to a passive allocation to Asia large cap, you can actually enhance return and also reduce risk by investing in smaller companies like Asia Focus. This is just a kind of map of our team. So this is our emerging markets team in general. We have about 50 people in emerging markets, of which 35 dedicated to Asia. All those 35 people are meeting companies on a daily basis. So we do about 1,500 company meetings per year. We have about 600 stocks under coverage and 400 of those on a buy list. So, we do have a very large team and quite well-resourced team to look at companies in this space. Obviously, that's all cap, not just small cap. But it does mean that we do have that resource to dedicate to smaller companies, which sometimes a lot of managers will ignore because it is quite resource intensive from a research point of view. Given that concentration in US equities, I think one of the things that I thought I would highlight is why bother with Asian small caps. We do think that people have been under allocating to the region. And there's really three reasons to consider investing in smaller companies in Asia. The first is that it does complement large cap Asian portfolios. They do offer different exposure from a country and sector perspective. They do often actually reduce risk, which might sound counterintuitive because you'd expect smaller companies to be higher risk. But actually, because those companies are so different to one another, in aggregate, the portfolio actually does bring risk down. If you think about large caps in Asia, we have a slide on this later on, but top 10 stocks in large cap represent about 30% of the index. So something like TSMC, which is the most well-known company in Taiwan, they'll be in Asian large cap portfolios, they'll probably be in global portfolios, they'll be in tech portfolios. So actually, within your portfolios, you probably have a lot more correlation between them than you'd expect. So smaller companies is a way of reducing risk. And we believe that because they're under-researched and because they're smaller, they actually have much more potential for growth and outperformance. And we'll drill down into that into a bit more detail. So, this just shows how differentiated the small cap and large cap indices are, and also our portfolios. So if you look at the top 10 weights there, which I referenced, about 30% in large cap. The small cap index is very fragmented, at about 4% of the top 10 is about 4% of the index. We are quite high conviction, so we have about a third of the portfolio in our top 10. But if you look at exposures such as China, China is 30% or more of large cap index, but it's closer to 10% of small cap. We can go into details later as to why, but essentially, you do get more exposure to other countries within Asia in allocating to small caps. So as you can see, India is a much larger proportion of the small cap universe, and also Southeast Asia is a much larger proportion. And then on the sector basis, you do also have quite a few differences there. The point about reducing risk, this is an interesting slide just over the last 3 years to look at volatility. Again, perception is that Asian small caps are a lot higher risk, but if you compare it to smaller companies in developed markets, it's actually been lower risk. And again, in terms of that diversification piece and outperformance potential, I think over the last 10 years or so, you've actually seen research into small caps in Asia go down, partly because of MiFID regulations, also because active fees have been coming down. Banks have been allocating less resource to covering small caps. So the fact that we have our own team doing that due diligence is pretty important. So if you look at the number of companies that have less than 3 analysts covering it, it's about 40% of the small cap companies. And actually, a lot of the companies that we invest in aren't even in the small cap index. And then on the dispersion of returns, on the right-hand side, you can see that actually every year you have higher dispersion of returns from small caps than large caps. So if you can pick the right ones, you have the potential to deliver better performance as well. And this is what you see over the last sort of 25 years or so. Obviously, it's a long period of time, and depending on which period you can take, you'll see underperformance. But over 25 years, Asian small caps, despite emerging markets being out of favor, has actually delivered better performance than US equities and almost double the performance of MSCI World. So we do think that it does offer pretty attractive returns. I guess the more interesting piece, at least from my perspective, is on the portfolio itself. In terms of our philosophy, it's really about quality, so investing in the best businesses we can find in the region. We have a portfolio of about 55 companies. The index alone has about 2,000 companies, so there's certainly a lot of companies to pick from. So we just want to be very selective. And when we think about quality, there's 3 things that there's more than 3, but I'll summarize in 3. Essentially, one being, the secret sauce, what makes that business unique, and what makes that business model have sustainable competitive advantage over its peers. So, is it a market leader? If not, why can it become a market leader? Is it because it has lower cost? Is it because it has a better brand, better distribution? There are many reasons why a business might be differentiated, but that's what we're really looking for. Second piece is around management quality and governance. Can we trust the people that are running these companies? Have they mistreated minorities in the past? So you could call that ESG as well. That's the second piece. And the third piece is around balance sheet strength and financial health. So companies that generate good cash flow, don't take a lot of debt. So you can see on the charts there that our portfolio has a much lower debt level than the index. So our portfolio is in net cash, which we think is pretty important, investing in Asian emerging markets, to have businesses that do have sort of idle cash around that they can invest when times are tough, either in terms of investing in the business or acquiring. And then in terms of profitability, our portfolio also delivers better return on equity there than the index. In terms of positioning, we look at it more from an absolute point of view rather than relative, but we have shown both in this slide. So the light blue is our absolute position and the dark blue is our relative positioning. We like to be pretty diversified across the region. I'd probably bucket our geographic exposure into 4 different groups. So India, and if you include Sri Lanka there, is our largest allocation. We think it's a very rich universe of companies in India to choose from in the small and mid-cap space. We are underweight India relative to the benchmark, primarily because of valuations. India has had a fantastic run, and we are a little bit cautious on some of the valuations there. So we do retain an underweight position. Our second bucket is around China and Hong Kong. That's approaching 20% of our portfolio today. We are slightly overweight China and Hong Kong. We can talk about that. We do think that China and Hong Kong are underrepresented in the small cap index. Going back to what I said around relative to the scale of China in the region. The third bucket is Taiwan and Korea, which are more export-driven markets, tend to be underweight those, but still have a decent allocation of around 20%. And the final piece is Southeast Asia, where we have historically been overrepresented versus the benchmark. So we have decent allocation to Vietnam, Indonesia, a bit in Philippines, and some of the other markets there. Sector-wise, similarly, we are quite diversified. Tech is a very big sector within Asia, both on the hardware, IT services, and software side. So it is a pretty diversified space. We are very light in materials, though, and also quite underweight in real estate. These are our top 10 holdings. I think the nice thing about a portfolio like Asia Focus is that most people haven't heard of any of these companies. So that's really the objective here, is that we're trying to give you exposure to companies that are very hard to access if you wanted to buy them individually. and they're extremely different. So if you look at our top 3 there, we'll go into a bit more detail on K-FinTech, which is the third there. But you can see that our top 3, in completely different markets, completely different sectors. And you can see also that our top 10, they're very hardly represented in the benchmark, which, is a truly active portfolio. If you want active exposure to Asia, we believe that going through a small cap portfolio is the way to get that deep access to active investing. Just to give you a little bit of color, Aegis Logistics is a LPG distributor in India. It's got a network of ports and storage terminals across the Indian coast. And with the demand for energy in India, there's a big push towards cleaner fuels. You might argue LPG is not the cleanest fuel, but it's much cleaner than coal. So there's a big push by the government to see that shift, or at least the growth in energy demand and supply to come from cleaner fuels. And Aegis Logistics have been growing about 20 to 30% per year just on volume terms. They make a fixed margin. So it's a very stable business. They have a JV with one of the leaders globally in this space, which is a Dutch company called Vopak. And that's been a strong performer for us. FPT Corporation, number 2 there, is an IT services business in Vietnam. We think it's one of the best companies in Vietnam in terms of their management quality. They have been also graduating about a third of all software engineers in Vietnam, which is quite synergistic to their IT services business. And again, that's a company we've held in this portfolio for about 6-7 years. And over that time period, they delivered 20% earnings growth year after year. Maybe during COVID, it dropped a couple of percentage points, but they've been executing really, really well. And then on KFin, just to give you another flavor, this is one of my favorite companies in the portfolio. It's really a play on the growth of the asset management industry in India, which, at least to my knowledge, is the fastest growing asset management industry in the world. They're essentially a back office service provider to asset managers. They only charge a 4 to 5 basis points fee. It's incredibly low, but they make a 45% margin and over 30% return on equity. They are only one of 2 companies that do this in India, so it's a duopoly. And they clip a fee or grow their fee, which is a recurring fee, with the asset management industry in India. So it's been a very strong story, and India has seen an explosion of equity investing. So you can see on the bottom right there that the number of domestic individual accounts, investor accounts, has been rising quite a lot. And the nice thing about it is you play the asset management industry without having to pick a brand or, back an asset manager which might have their own performance issues. Final thing to say on this one is they have a big opportunity internationally as well. They've just signed a partnership with BlackRock to be one of their 9 providers of their services. And that will be a much bigger addressable market than what they have in India. And they charge about a third of the price that international peers charge for what they do. Couple of changes to the portfolio, new holdings that we've added in China. We have been incrementally more positive in China over the last few months. And these tap into different consumer trends in China. There's a lot of talk about demographics in China and the aging population, people having less kids. But one of the things that they are doing is they're having more pets. So if you look at the last 14 years or so, number of pets have increased from 59 million to 187 million. People might not want kids, but they still want company. So, you see, it makes me laugh as well, but the penetration of dogs and cats is only 22% in China compared to 70% in the US. So there is room for growth in that pet ownership story. And local brands are gaining market share. So these are the local brands, or the key local brands in China, and they're gaining market share from Western brands, given there's also a big localization drive in China to consume more locally, given the tensions that you see with the US. The other stock there on the right-hand side is essentially the Spotify of China. There's actually 2 of them. So one of them is owned by Tencent, and the other one is NetEase. So we invested in the number 2 player. They've been seeing a big increase in both user base and also the number of paying users, which is only still 27%. So there's a big opportunity to monetize their user base, and you see that reflected in improving profitability. So, I think one of the things that you've seen in China is whilst consumption has been weak, there are certain areas that people are consuming more in. So people are more likely to spend on services, on travel, on entertainment, rather than on goods. And I think that's a trend that you've seen across the world post-COVID as well. In terms of portfolio characteristics, historically the strategy has been pretty defensive given that quality bias. So you have these ratios here. In terms of the capture ratio on the downside, we tend to protect quite a lot of capital when markets are weak. Valuation-wise, the portfolio has increased in valuation a little bit over the last 6 months, primarily because of India. But at 17 times, we think that's still relatively reasonable for the growth on offer. Again, here you show the return on equity and the net debt to equity versus the benchmark, which are metrics to measure the quality of the portfolio. We are on a pretty big discount to NAV, around 14%. This is to the end of Jan, so it has fluctuated a little bit. But given the asset class has been out of favor, most Asian and emerging market trusts have been on big discounts. And I think there is a perception that smaller companies are higher risk. So that discount has persisted for quite some time. And finally, on performance, I won't dwell too much. I think over the last year or so, the NAV has risen about 18%. That's about 10% ahead of our small cap benchmark. We do often look at large cap benchmark as well to provide some context. So we've had a good 12 months. Over 3 to 5 years, the outperformance versus the benchmark has been a little bit less. And I have slides here talking about the relative performance, but I probably won't dwell on that. I think a couple of things to say just in terms of our India stock selection has been strong, also in Hong Kong. And in Korea, there's been a lot of volatility with the impeachment of the president and political noise, and our underweight there and some of our more defensive stocks have helped. I will probably stop there. I have slides on the outlook and the on individual macro slides, but I guess we can touch on them depending on the questions that come through.
Gabriel, thank you very much. Thank you. Okay. As a reminder, raise your hand if you have a question, please. Over here, please. Oh, we'll start at the back then. Okay, thank you.
Yeah, I think you mentioned the phrase secret sauce. So my question is, was Hugh Young the secret sauce?
You're asking the wrong person probably, because I have to follow in his footsteps. I think Hugh was very good at well, let me take a step back. When Hugh started investing in Asia in the late 80s, I think one of the really important things that he did was to focus on governance. I think Asia and emerging markets have come a long way over the last 20, 30 years. Back then, there was, I think we didn't even have a small cap index. It was a much more volatile and unknown place. So I think his focus was very much on the people behind the companies, which I think was instrumental in terms of our process. So I think that philosophy has been in place and is a core part of our process to this day. And the other thing that he was very instrumental in doing was just building the team out in Asia. So he grew the business from 2 or 3 people to our emerging market franchise to about 50 people today, and we've rolled out funds across emerging markets. So I think Aberdeen as a house is well known for their emerging markets franchise, and I think he really liked Asia Focus because it was very differentiated. I think he retired at the end of last year, and one of the things that he was always very adamant about was to be brave and bold versus indices, because I think that's the direction that markets have gone. So he was instrumental. I think the reality is that the process is really driven by the team. So it's not Hugh, it's not myself. We help to manage the portfolio construction, but the ideas is coming from our 35 people on the ground. We have 10 people in China, about 15 people in Singapore that help to cover some of the other markets. We have offices also in Malaysia and Thailand. So, we have people on the ground meeting companies day in, day out, and that's where I think the differential comes from. I don't know if that helps.
Yeah. Then, because he was very, I think he actually knew personally a lot of the companies that you guys invest. I used to hold it, by the way. So, so it's the reason I ask is for the simple reason that I've seen lots of funds and/or investment trusts. And I suppose typical is Terry Smith with Fundsmith, and who knows what's going to happen when he goes. But when people seem to go, for example, Scottish Mortgage or whatever, they seem to go and they are the secret sauce.
Okay. All right, I'm going to back myself here. If you look at the one-year performance, right, so he retired end of last year. Where is it? Okay, this is not helping me. So one of the things that we did and the board asked us to do was when he retired at the end of last year is to take a fresh look at the portfolio and make sure that the portfolio is our own rather than just second guessing what Hugh would have thought. And one of the things that we've been very diligent about is looking at each holding in the portfolio and questioning whether we should hold on to it. And what we actually did was shift about 10-15% of the portfolio and get rid of a lot of legacy holdings that we've been holding for a long time. And whether it's luck or not, in markets, you do have to be lucky sometimes. But, I think over the last year, we have delivered really strong alpha. And if you look at our top 10 holdings, we do still hold some stuff that has been in the portfolio for a long time. So John Keel's in Sri Lanka has been held since inception of the portfolio. But there's a lot of other examples that we just felt these are deep value names, but there are no catalysts and we don't have any visibility on the earnings. So we don't want to sit on 10 to 15% of the portfolio that we don't know when we'll realize that value. And in the meantime, we have fantastic businesses to own. So essentially, we shifted and wanted to get rid of that opportunity cost, essentially, into new ideas. And, that's not because we changed the process. These are discussions that we had with Hugh as well. So I've been working with Hugh for 7-8 years in this portfolio. And when I got involved, we brought the number of holdings down from about 80 to 50. So we were refreshing the portfolio already, but we did accelerate that process a little bit over the last 1 year. So I think one of the dangers with quality managers, and we've seen it ourselves over the years, is to get into a quality trap. You buy a company that you think is a quality company and you sit on it for too long. And we just have too many companies to invest in. So we decided to shift.
Okay,
yeah, sorry.
Please,
Thank you for the presentation. Could you say something about your exposure to, on the one hand, currency fluctuations and also the liquidity or otherwise of the small cap companies?
Yeah, so I'll take the liquidity one first. I think, the benefit of having the trust is that we can be a little bit braver in terms of liquidity, and we can buy companies that, in a mutual fund you probably wouldn't do. So for example, Precision Tsugami there, that stock is extremely illiquid, but it was trading on 5 times earnings with a 10% dividend yield, and they've actually delivered about 50% revenue growth over the last year. So incredibly sort of value and growth opportunity that was at that level because liquidity was poor. That stock's up 150% this year, so we've started reducing it quite aggressively. But it does, it doesn't always work that way. You could be trapped into poor liquid stocks. But I think the benefit of our structure is that we can go a little bit further down the liquidity spectrum. I'd say that over the last year, we've really improved the liquidity profile of the trust. So we have reduced a lot of the more liquid holdings that are more deep value. So it is a little bit more liquid today. On your other question was about the currency fluctuations. We don't hedge. I think at the company level, we're very careful to make sure that the companies themselves are not vulnerable to currency movements. So one of the key things when you talk about quality is companies that don't take foreign currency debt. When this portfolio started in 1995, it was just before the Asian financial crisis. And one of the reasons it did so well initially was because we didn't back companies that took a lot of debt, particularly in foreign currency. So OCBC NISC, which is not on this list, but is a bank in Indonesia, we've held that since inception, and that's a bank that survived the Asian financial crisis. So we try to think about currency also on the portfolio level. So if we're worried about the macro, we just try to minimize our exposure to that country. So for example, at the moment, we've been reducing a little bit of our exposure to Indonesia because there's been a little bit more volatility there in terms of the macro and the politics.
Next question, please. Yep.
Hello, you nearly touched on it in your presentation. I wondered what you could tell me, please, about Chinese demographics.
Yeah, sure. I think the whole world is aging, and I think China is no different. It's still a very large population, but I think the classic thematic in Asia is to play the growth in the middle class. I think that's happening in China, but not from a sort of population growth point of view. It's more from a GDP per capita growth point of view. India just overtook China in terms of population, and I think the government is now putting in place policies to try and support people having kids. So they just had a couple of important economic meetings called the 2 sessions, where they have put in place tax breaks and subsidies for people that want to have more kids. They're trying to support education, etc. But I think demographics or demographic growth is slowing across the world. Where you see more interesting demographics is in places like India, Indonesia, Philippines, where birth rates are still quite high. But I would say that demographics are not the most important thing. I think if you look at the consuming class globally, about 2/3 is in Asia. So if you think that there's more growth in Asia, that consuming class will grow faster in Asia, and that's where you see a lot of Western multinationals seeing the most growth, be it Louis Vuitton, be it L'Oreal. They're all seeing the most growth from Asia.
Question here, please.
Quick one, 2 actually. Your discount to NAV is about 14%. What's the policy to reduce it? And is it possible that it's just a risky trust and it's already been priced in? And secondly, how do the emerging markets, do they want a strong or a weak dollar? Because we don't know what Trump's doing and what the effect will be. But could you give an overview of how emerging markets react to a strong or weak dollar? Thank you.
Yeah, absolutely. So the discount, the board have been trying to reduce the discount, but it is out of the board's control to an extent. So what the board did in 2022, they had a strategic review. So they doubled the level of the absolute dividend, which is completely covered by income, and tried to make it progressive. They're paying that quarterly as well. They put in place that conditional tender offer so that, if we don't outperform the benchmark, 25% of the capital is returned every 5 years. They also implemented, changed the fee to be linked to market cap rather than NAV, which just means that as a manager, or we're incentivized to close the gap, even though we can't really do too much. So there's a number of things that they've done. They've also stepped up the buybacks over the last 6 months. But, you know, there's only so much you can do. I think the discounts across the investment trust sector have been very wide. And as you say, I think because of the perception of emerging markets, Asia and small caps, it just persists. So it has narrowed, but it's still quite wide. My view is that, you know, we only can narrow that discount through performance. So, you know, hopefully if performance continues to be strong, then that discount gets narrowed. There was another question. A strong dollar is bad for Asian emerging markets. So both a strong dollar and high rates in the US is bad. What you've seen over the last 10 years is just outflows from Asian emerging markets. So we have a slide here on that later on. So these are fund allocations to Asia, which are at decade lows. If you see a slowing US economy and cut in rates, that's positive for Asia and emerging markets. So that's something that we have been expecting for some time. Obviously, because inflation has been a bit sticky in the US, rate cuts haven't come as fast. And that's something that we can't really predict. But I think macro-wise, Asia is in a reasonably good place, and inflation hasn't been a problem. So as soon as the Fed starts cutting rates, you've already seen a lot of emerging markets start cutting rates as well.
Gabriel, thank you very much indeed. We're out of time now. Thank you.